My name is Pam Webb. I'm located in the Ardmore, Oklahoma Transformance office. What we're going to do today is talk about the interest rates and why should you care. And get started here by telling a little bit about Transformance. Our mission is to empower individuals and families to achieve financial freedom. We're here to adhere to the highest business standards and maintain our accreditation by an independent third party known as the Council of Accreditation. Our counselors are certified by the NFCC, and over the past 42 years, our educational programs and counseling coaching sessions have positively impacted over 1.7 million lives. I'm proud to work for a 501c3 nonprofit organization that is dedicated to keeping the clients at the heart of everything we do. Transformance vision is as a financially sound community. We value integrity, compassion, professionalism, innovation, and accountability. We're working with strategic partnerships that share in our vision, and together we can empower individuals and families with resources that provide long-term financial stability. In this webinar, we're going to focus on primarily 4 areas: just the very basics about the interest rate, what the current rates are, and how the rates can impact you long term, and are there tools out there that can make you more aware of how you would be receiving lower versus higher rates? And I can say yes, there are, and we're going to go over some of those tools here as well. So when we're talking about interest rates, let's just define what an interest rate is. And basically what it is going to be the difference between the purchase price that you're going to see that it would cost, and if you're going to be paying it out long term based on a loan, it's going to be the interest will be added to what you actually purchased the item for. So it can make a big difference on the overall cost. Now, when you're looking at the different types of rates and how they get calculated, we're going to also identify that some of the interest rates on long-term loans, like the bank loans and car loans, they are going to be typically based on what they consider the prime rate. That's where they'll start, and then the rates can vary. But the prime rate is basically what they consider under the federal fund rate, and that's what the banks can actually charge one another for the overnight loans that they have. That website right there, that Investopedia, you might want to write that down and keep that as a reference for some additional information. Looking at the interest rates on the long term, you're going to have a big difference between what you could have even on your monthly payment if the interest rate is a lower rate versus a higher rate. And of course, then that's going to impact the overall cost as well. Right now, we're looking at prime rates right at 3.5%. And another website you might want to just pull up is called bankrate.com, and that way you can have a reference to how the rates will be changing and kind of give you an idea of how to prepare for that as well. When you're looking at the interest rate, it's not only what you can be charged for taking out a loan or the cost of taking out a loan. It also, interest rates can impact the amount of savings that you could earn. So if you're looking at a money market or CD account, something that will allow you to invest your money and let it just sit there, don't use it, let it build in value, they also calculate the rate on savings account. When you're looking at the cost of a loan, you typically are seeing something in the listing here that we have, either payment, a car loan, personal or credit cards. All these types of loans are going to have an additional cost to using the money that's available. What drives the rates up and down is basically the Federal Reserve. And some of the factors that are going to influence these rates are the supply and demand. If the Federal Reserve wants to lower the rate, you're going to see, based on the listing there, what factors that they have thought through in order to be able to move the rates down. And you're seeing that line right there. It could, if they're really wanting to spur borrowing on or push spending, to boost the stock market, those are going to be factors that lower the rate. And then the listing underneath there, if the Federal Reserve wants to encourage saving or reduce borrowing, less discretionary spending, then they will raise the rate. Historically, what we have seen over the last few years is the lower rates than we've seen in a long time. And the factors that have influenced the lower rates are basically the recession that we've been coming out of, the housing crisis, stock market recovery, higher unemployment. So there's a lot of factors that actually have driven down the rates that we've seen lately. When you're looking at the current rate, there's a pretty good difference between what actually the funds would be calculated in growth and cost. And one of the yield curves is what they reference is the interest rate that the government pays to borrow the money. So if you were wanting to, say, take out a treasury bond, you may purchase this bond at a lower price, but you're not actually going to get, say, a $50 savings bond. You're not going to actually get to turn that back in say, a year and get $50 for that bond. There's the difference is the time frame that you're going to have to wait for that that particular tool of investment to grow in value. They typically will pay interest either semi-annually on the note or the bond. The bills are going to have, their maturity is going to be less than a year. You can see there's a variety of loans that get calculated with interest rates. Student loans is definitely one of the ones that we have seen and can be a significant difference when you look at that, the plus loan rate versus the subsidized loans. You can see even a couple of difference in that points can make a huge overall difference in the cost of what you borrowed for a student loan. And then the HELOC is a home equity line of credit that basically is using part of the equity that you have, that if you have a house and you have paid a portion of this loan down, and then you could borrow against the portion of the home that is already paid off. And to do that, again, you have to go through a application process, and depending on what your credit score is and the terms of the loan will determine how costly that type of loan would be as well. When you're looking at having the savings account grow in value, there's some couple of different examples here on money market account and interest earning checking accounts, and they're really right now really low rates. But don't forget, any amount that you have as far as even a small amount of growth in a savings will add up eventually. So if you can take advantage of the interest checking accounts or the money market accounts, do so. Now, you can see based on the auto averages right there that there can be also a significant difference in the rate on the cost of a loan. And so it's important when you're looking at loans that would be long-term, before you get in, before you sign up for that and are going to be obligated to a long-term loan, if the lower your interest rate can be, the lower your payment, and also the less costly the overall purchase price will be. Let's talk about some of the visuals of the difference an interest rate can make on a payment and the overall cost. This is an example of a fixed rate mortgage payment. If you were taking a obligation on, for example, of a home that cost $150,000 and you said that you're going to pay this off within 30 years, they are going to look at your credit score. They're going to see what's been going on in your past history. The higher your credit score, the FICO score is, the better interest rate that you're going to be receiving. It's called a prime rate. So if you're getting a prime rate, you can see that the monthly cost for that same house that could cost $640 for someone that has developed good pay history could have an overall cost. And do you see the difference too? You borrowed $150,000, but look at the cost of this home. You see, that's the difference between the purchase price and the 30 years that they've added interest to the cost of that loan. So if you're starting out with a higher FICO score, even though you're going to be paying more overall for the cost of that home, look at the difference between a lower FICO score and the overall cost of a home. So it makes a big difference and especially if it's a long-term loan, to get a really good rate. Here's another example of a higher cost home, but again, if it is based on the higher the FICO score, the lower the house payment. And going through the lineup there, you can see if you have a 9% interest rate on this type of loan, that will more than double your payment. Let's talk about something like credit card balances. How does that differ between something like a mortgage payment? Well, interest rates are going to be higher on unsecured debt. A credit card is not going to have anything that secures it if something happens and it doesn't get paid. A house payment, if you get behind on that, they can actually foreclose and take ownership of the home. So unsecured debt would be something like credit cards, and so you're going to have a higher cost because there's a higher risk for that lender to extend that line of credit. Once again, though, as you can see, the terms of the credit card here identified a $28,000 balance, and they are indicating if you want to borrow $28,000 and pay that out in 5 years, you're going to have to come up with a payment that's right at $554, and the cost of that loan at that 7% interest is quite a bit. But look, if you were just using that same dollar amount but paying it out within 10 years. 10 years, same interest rate, you're going to have a lower payment, but the overall cost is going to be higher. So there is some pros and cons when you are trying to take any type of loan out or use any line of credit, and you want to just calculate the cost before you get into that long term. All right, let's talk about just some of the benefits of having a higher credit score. You can have the process of getting a loan is going to be faster. You're going to have some measure of probably a larger credit amount. You may have the overall price could be offered to you at a better rate. So there are definitely some advantages for the lender to offer a line of credit to someone that has a history of paying back their loans in a good standing. One of the tools that you can have and know that could be in place is what an agency called the Consumer Financial Protection Bureau is basically a government agency that's going to make sure banks and lenders and other financial companies are going to treat you fairly. And so they're going to provide ways for you to identify what's on the credit score. How do you become familiar with what factors are making you a higher or lower risk based on a credit score. And sometimes you can have information on a credit report that's inaccurate. In fact, as it's been noted right there, there's approximately 32 to 38 million potential errors on a credit report. So it's important to identify your credit report, what's on that information, what credit lines are showing, are they accurate, and if they're not, you want to take a time to get that disputed. One of the ways that you can find out what's on your credit report, what we would use as a referral is annualcreditreport.com. This would allow you to obtain a free credit report once a year from all three bureaus. without having to have any type of ding against your credit score, and it gives you an opportunity to use online without having to use a credit card or join any ongoing services. Some of those type of online credit reports agencies can do. They can kind of sometimes even offer a free credit report, but before you know it, you're putting your credit card number or a payment with in some form for that. So you want to be on guard not to get tripped up into something that in that nature. At annualcreditreport.com, if you have those reports pulled and you're not familiar to really understand how the information is being identified, Transformance does provide a credit review service. And so if you have those reports and want to call and schedule a review with one of our coaches or counselors, feel free to do that. That can really benefit you. And if you are wanting to know what your credit score is, the annualcreditreport.com doesn't provide that, but Credit Karma will. So if you want to give you a kind of a base amount of just understanding of what your score could be without having to pay for that score, Credit Karma might be the resource that you would want to look at. So we're about to end this webinar, but we do want to be sure that everyone is aware of another tool that we have made available called Pocket Change. Pocket Change USA is designed to give skills that you're going to want to have and need to take control of your financial future. This particular tool can be downloaded free of charge on any type of mobile phone, iPad, any of the, I think even now the computers are available to download this, and you can view this at Google Play or iTunes Store. This is going to really be a really good tool that will be hands-on for you. It's going to improve your financial capability. It's going to give you an opportunity to build a short-term and long-term budget plan. You can connect to a counselor or coach, and there's some gamified ways just to keep you sharp on different decisions that you may have to think through and make in a timely manner, such as insurance, savings, credit. And if you have any questions after you download that, feel free to give us a call. We appreciate you taking time to attend our webinar. Certainly we hope to see you again with the credit report review, and also any other the webinars that you find of interest that might benefit you to take.